the key issues in the Intangibles Migration Arrangement PCG 2024-1. This PCG focusing on the risk assessment framework for intangibles, and it outlines examples under which particular transactions can be classified under high-risk transactions or red zone. And those transactions are centralization of intangibles, bifurcations of intangible assets, or non-recognitions of Australian DMP activities. So taxpayers are required to self-assess their intangible arrangements and take actions appropriately in accordance with the risk zone. And we wanted to highlight at least one case study which is highly relevant to taxpayers when it comes to internally generated intangible assets. The facts of the case here is we have an Australian manufacturer. It has operation in the US, and the US entity is established under the same brand name. And the US, there's a US third-party contract manufacturers produce the products and then sell it to the US code and sell it to the US customers. So under the PCG, this type of arrangement classify under red zone, high-risk transactions. And you can go through the risk assessment factors here, where we need to answer the questions on whether any intangible assets have been transferred or licensed to overseas, and whether the overseas entities is a newly established entity or not, or whether there is any intercompany agreement for the intangible assets. After going through all the risk assessment factors, you will get the corresponding scores. And in the scenarios, it landed 35 scores, and it is under the high risk type. And there's several key questions that taxpayers will need to answer if the transaction is classified under high risk transactions. One of the questions they need to ask is, how does the OSCO give the access of intangibles to the US code, whether it will be under the licensing arrangement or cost-sharing arrangement or any other form of the compensation. So we wanted also to highlight to you another big topic, which is the transfer pricing dispute. So in recent years, the ATO and the commissioners have significantly increased the scrutinies of transfer pricing arrangement, especially those involving intercompany financing and intangible assets. And it is reflected in high-profile cases such as Singtel, Mylan, and PepsiCo. And for the context of our today's session, we will focus on one case, which is Singtel case, and highlight the key takeaway for the taxpayers. So under the Singtel case, the key facts are Singtel Australia acquired all shares from Singtel Optus through a $5 billion loan from Singtel Singapore under a loan note issuing agreement. And the loan note was amended 3 times, increased the interest rate from the original rate of base rate plus 1% to 13.2%. And the ATO issues the amended assessment, disallowing the interest deductions for Singtel Australia. The key issue of the case here is about whether Singtel Australia has obtained any transfer pricing benefit. And it involved 2 questions, condition questions and profit questions. So in terms of condition questions, it involved whether the condition between Singtel Australia and Singtel Singapore differ from what would have been agreed by independent parties. And under the profit issues or questions, it refers to whether it was a reliable hypothesis that independent parties would have agreed to the Second Amendment or the Third Amendments of the law note. And at the end, the court found that the independent parties, under similar circumstances of Singtel Australia and Singtel Singapore, would not have agreed to the Second and Third Amendment of the law notes. So the key takeaway for taxpayer here is, number one, commercial rationales of the transactions. We need to ensure that we explain the commercialities of the transaction on why particular transaction need to be amended. And second, the reliability of the transfer pricing analysis that support the arm's length positions of the transaction. So as a summary of effective strategies for financing arrangement and intangible arrangements, as we discussed earlier, for financing arrangements, there are 3 different types of rules need to be addressed. And therefore, it's important for taxpayers to ensure they optimize capital structures to achieve the best balance between debt and equity. For intangible arrangement, it is important that taxpayers perform an annual review of DMP activities associated with the intangible assets that could be internally generated or acquired externally. And those reviews is expected to be performed annually. Moving on to another topic on Pillar 2. In this slides, we show you the evolutions from BEPS 1.0 to BEPS 2.0. BEPS 1.0 refer to the 15 actions released by the OECD in 2015. And in 2021, there's 2 solutions introduced by the OECDs, which are Pillar 1 and Pillar 2, to address the tax challenges posed by the digitalizations of the global economy. Pillar 1 refers to reallocation of taxing rights. It ensures that countries where consumers are located have the right to tax the profit generated by the digital companies. And Pillar 2, it established the global minimum tax of 15%. So companies with a profit above the certain threshold must pay a minimum level of 15% of tax in every jurisdiction that they operate. So up to date, there are 140 jurisdictions that already signed up for the 2-pillar solution, and that 140 jurisdictions represent 90% of the global GDP. It shows strong commitment between countries around the globe in terms of the 2-pillar solution. Just a quick one on Pillar 2 implementation in Australia. In terms of scope, it applies to the MNEs with annual revenues of over 750 million euros. This application or this scope is in line with the OECD guideline. And in terms of effective date, the global minimum tax rate and domestic minimum tax rate would apply to the fiscal year on or after 1st January 2024. And the undertax profit rules would apply 1 year after, on 1st January 2025. And this Pillar 2 solutions include several applications. The first one, domestic minimum tax. It allows Australia to apply top-up tax on the Australian subsidiary of an MNE group so that it can bring the effective tax rate of that entities up to 15%. Second, global minimum tax it allows Australia to apply a top-up tax to an Australian parent company of an M&E group, where the group incomes in any other jurisdictions is being taxed below 15%. And the under-tax profit rules apply to the apply so that Australia can impose a top-up tax on resident subsidiary if the group incomes is being taxed below 15% and where there's no global minimum tax rules apply in their jurisdictions. In terms of the timeline of the new form, global income information return form, and Australians income insurance rules, tax returns, those forms, additional obligation to taxpayers will be due 18 months after the year end. So, in summary, there's key recent development that taxpayers must be aware of in terms of financing arrangement, intangibles, and also the interplays with the Pillar 2 implementation in Australia. And with that, I would end my sharing session here, and I would hand it over to Ai Chen, who will take us through the enterprising landscape in Malaysia.
Thank you, Becky. Hello, everyone. Thank you for joining us today for this session on the recent development as well as challenges on transfer pricing for Malaysia perspective. As you can see in this slide, these are the landscape of transfer pricing development in Malaysia. As you can see, the latest recent one would be in 2023. Sorry, my slide's not moving.
We'll just wait while Ai Chen resets. And if anyone has questions, please don't forget to put them in the Q&A section. I can see it's empty at the moment, so don't be shy to put something in there.
Is it moving now? Is it moving now?
Yes, moving
Yes,
now.
Ai Chen.
Okay,
Yes,
sorry
you can
about that.
continue.
Okay, as you can see here, the landscape in Malaysia 2023 is a recent update on the new rules 2023. Okay, let's look at the update. 2023 onwards, a new contemporaneous transfer pricing report there's a requirement to submit prior to submission of tax return.